Mr. Shane with the Rational Trader. It's May 12th. We're going to go over these items here on our weekly update. The first is risk management, where I'm a little concerned that some folks, especially those that are relatively new to the Rational Trader, are not paying attention to this correctly. So we'll talk about that. I need to do some work there. And then we'll go over the status of the order flow momentum signal, which I believe is causing some folks some issues with in regards to not getting the same predictions as me. And we'll talk about some updates to Rev 52, which is the current production model. I'm sorry, Rev 55, which is the current production model. Rev 62, which was a test I did this week, which I found very interesting. And then the second method of doing verification. We're going to talk about trail methods, particularly in light of something that happened last week. It really sort of highlights it. And then we gotta discuss this week's models and how those are going to get built, because we have a decision to make in terms of assessing the volatility in the marketplace. So for risk management, let's start here. Where did that go? So in the download section, is actually the old download section, is a business plan here. Let me go back one. So if you go to the normal download section, there's this pre-ML downloads. So there's a bunch of downloads for prior to the machine learning system coming online. But there's one thing in here that is actually really useful, which is the business plan. And I'm concerned that I didn't, or I haven't emphasized this enough with people that are newer to the Rational Trader and haven't had this sort of drummed into them over the years. As a trader, your job is to manage risk. It doesn't matter what system you're using. It doesn't matter if you're a discretionary trader. It doesn't matter if you use some automated system. It doesn't matter if it's machine learning and artificial intelligence. You manage risk. That's what you do. Okay? And the reason that's necessary is that this is a probabilistic environment. We don't know what's going to happen. And when things are going against us, we've got to keep our losses under control. It's really no different than a business. A business, keeps their costs down and maximizes profits. We're doing the same thing. All right. So when the market is not behaving in a way that's in line with what our expectations are, and we take losses, you got to keep those small. And we call it a max loss day, right? Another way to think about it is it's a managing risk day. All right, and so we don't allow more than X amount because we can't dig that hole too deep. And the only reason this works is that we keep losses small and we let winners run. All right. And it's very, very clear when you look at the results of different replays where we limit the upside, where we set the target to like 40 ticks in the NQ instead of 80, and the results are dramatically different. All right, you got to let the winner. You have to let the trade that's winning run. You don't want to cut it off, and you got to keep the losses small. Okay. The machine learning doesn't change that need. All right, it's just what machine learning does for us is it's the first method that I've seen that you can actually use without human intervention. But it doesn't mean that you're going to make money every day. By no stretch does it mean that. Though people often think that, it's AI, so that means I'm never going to take a loss. That's not the case at all. Right? Even when things are like normal, we've been dealing with some odd volatility issues, but even just normal times, managing your risk is the most important thing that you do. If you just look at if you look at the baseline replay that we use to judge changes, you'll see that in December was flat. Right? And there are long stretches of taking losses, and then you came out of it, you would actually down if you included costs. And then in January, you just hit it out of the park. It's where all the profits were made in January. That's what this is right here. This baseline. This is the baseline here. So from 12.8 to 12.9, that's running P&L of $75. You're actually underwater with costs, given these trades, right? But then January rolls around, and this is where all the profits get made. But even then, if you look at this, stupid Microsoft one. If you look at this and you can see very clearly that you've got stretches like this. That's December. Stretches like this. Stretches like this. This is when the markets got volatile, so we want to ignore that for this discussion. Okay, this is not unusual, all right? And you have to be able to deal with that. And if you can't, then you shouldn't be trading. You shouldn't be trading futures. So what the machine does for us is it removes the human element from the equation. So if I've taken a loss on the 8th and 9th, in the past, I would stop for trading for the week. I personally, as a human, would stop. That's what this business plan says. If I'm down 2 days in a row, I don't trust that I can trade with clarity on the next day. All right, so I would not trade the rest of the week. And you can see in this case, I'd end up missing out on, the days where the profits are, right? So this week, the total profit was $335. All right. What I did, so I used to have a set of rules that are described here in this business plan that talk about how much risk to take per day, or per trade per day and per week, and then rules on how you need to manage yourself. Now, I changed these rules when I went to machine learning, in part because I'm able to take less risk per trade. This was mostly talking about 2% risk per trade, $100 risk per trade, whereas I take 50 now. So it's more like example 1 or example 2 here. All right. The other thing that I noticed was that it's not unusual to have a couple of days where you're taking a loss and then the next day you're fine. And the machine just does it, right? It's not like a human where now you're cautious or you're hesitant and you're not assessing the market correctly. There's none of that involved. All right. So what I've been doing is I'll take 1% risk per trade and I'll take 3 losses a day, and I'm willing to do that for 3 days in the week. That's a big number if that happens. That's 9%. Okay. So for you, that might be too much. That's more than you're willing to do. If that's the case, you need to adjust that one way or the other, assuming that you're using a $5,000 account. If you're using a larger account, then those numbers just got cut in half. Okay. This is the easiest trading I've ever done because I'm never worried about, okay, am I thinking clearly here, or am I letting the fact that I was down yesterday affect me today, or am I letting the fact that I just took a loss affect me on the next one? Okay. But that doesn't mean that these are the right parameters for you. If you freak out when you're down 9% on the week, then you can't do that. You need to adjust it accordingly. Okay. So really, I think this needs to be updated. You can see this is 5 years old. This is when I first started doing this, and I think it needs to be emphasized more for the people that are newer to the rational trader. We talk about it, but it's never been stated here. You need to go read this and make your decisions. All right. All right, so then, okay, so order flow momentum update. What we're talking about here is, let me see, can I stop one of these? Let me stop this one on the left because it's basically bad news. What we're talking about here is the fact that actually, no, this test is invalid because I'm missing the chart. Shoot. Okay. Hang on a second. All right, so what we've done is we're taking the brights, which is the momentum that's coming from this 15-second chart, and we're building into the predict study itself. So that chart's not necessary, and the timing issue that we're seeing will go away. That's the intent. So this predict study now has these settings in it, which are basically used to match what that other chart is doing. And the idea here is that we will we can eliminate this chart by doing this. All right, and so then these subgraphs here are the order flow momentum long and order flow momentum short. These names are wrong right now. All right, and so if I change this to the color bar hollow and bright, this is up, so this should be bright green, and then this is down, and it should be bright red. Then we can delete the where is it? There it is. We can actually delete this chart here, and we'll still get what we need. All right, so I got the beta from the programmer last. So if we delete this chart now, close. We still have our brights here because they're being calculated in the study itself instead of external to the study. So, but there was a problem where it wasn't working in real time. So we have fixed that. We can remove that now. We fixed that, and now I ran it live yesterday, and it looked good. I need to run some further tests, and then that will go out. Earliest would be Wednesday. All right, and if you want to use it, you'll need to. There'll be a chart book update, so it's not required, but eventually you're going to want to switch over. Okay, so those of you that are struggling with this issue, you're going to want to do it right away. Okay, so that's that update. So I need to do some. What I want to do is basically do replays using both sets of methods. And I should get identical answers. And then if I do, then I'll just run it live for another day or two to make sure it's okay, and then publish it. Okay. What's next? Okay, so then we're going to talk about Rev 55, 62, and VBAR 2. So there's a test that's running right now. Actually, it's using Rev 55, but it's running the verification bar 2. So let's review what that means. Let me find a signal here. So the idea here is, let's take this 285 right here. So this 285 is occurring on an up bar. And in this particular case, that's a sweet entry. You're going to short that right at 69.63. The problem is that we're seeing cases where the market is continuing higher a bit before it rolls over, or you're just getting the market's just cranking and you're just going to get crushed. And so VBAR 2 is a different verification method, a verification bar. So there is a VBAR spreadsheet out there which will not enter unless it sees the next bar in the direction of the trade. Okay, so in this case, that would fire right here because the next bar is a down bar. All right, but there's a fair number of times where this bar could be closing down, and you want to get in right then, because it's a short signal. But then the V bar will wait, and you end up getting in late because of that. And then you have the other case where it actually continues to go up just a bit and then rolls over, and you're getting stopped out just as it finishes the roll. So what V-bar 2 does is, if this signal is a short signal and it's a down bar, then it just places the order. If it's not, then it looks for the next 2 bars for a down bar. So that, in this case, that would be right here. All right. Here's an example right here where it's 201. So that, and that's a down bar, so it just places the order. Okay. Here's a 287. So it looks like it's not placing it, likely because of the noise filter. But it would place that order. You know, that's an up bar, so that's no good. That's an up bar, that's no good. But that's a down bar. It'll place the order right there. Okay. So my thinking was, well, basically I've got some protection in place for using, you know, more aggressive codes. Now, when I take V-bar 2 and I use it just against the normal, you know, I just run the normal baseline, it's worse. Okay. So in normal conditions, you're better off just taking the trade when you get the signal, regardless of the direction of the bar. Okay. So we covered that last week, actually, in last week's update. But it occurred to me, as I was falling asleep last night, that maybe that means I can use a more aggressive stance if I'm using V-bar 2, because it'll protect me from those cases where the market's just cranking in one direction and the system is predicting the turn that's just not there. And so that's what's running right now. That's what this test is right now. And at one point it was looking, hang on, where did it go? At one point it was looking, you know, dramatically better, right? Here was like, this is the baseline here, right? And we were looking at it, and it was, you know, if you look as of the January 12th, it was, you know, that's pretty good. That's twice as good, right? But it looks like it's about caught up now. We'll see. We need to get all the way to February 2nd to get a real answer. But currently we're at 1835 on 123. So it's better here right now at this point. It's kind of interesting to watch because you can see sort of an ebb and flow of the different methods in terms of their profitability. I'm encouraged by what I'm seeing here. If you do totally aggressive, you just get you get killed a lot. So this is interesting what we're seeing here. It also looks to me like, ironically, there's less of these max loss days. Is that right? I'll have to do a formal analysis and see, because I think that's something it would be nice if we could figure out how to reduce these blocks here. These tend to freak people out. That's why I talked about risk management at the beginning today. I had a couple of users that were like concerned. All right, now the other thing I did this week, this was in discussions with Davey about one of his user-defined strategies. So we released user-defined strategies last weekend, and some of you are starting to experiment with it now. And what I did there was, he does a let me bring up Rev 62. He has a user-defined strategy that uses a 1334 cross. So let me bring it up here, and then it'll be easier to explain. So he's got a 13 period moving average and a 34 period moving average, and then he does something when they cross. I'm not exactly sure what, but I was curious to see if so that's what this is. The green line is a 13 period moving average, and the yellow line is 34. And I was curious, if I gave the machine learning system this information, what would it do? Would it do better or worse? Actually, that's not true. I assumed it would do better. In fact, I was almost certain it would. And in fact, it doesn't. It sucks. So I add this one piece of information, which is the delta between the 13 and the 34. And instead of getting, and then I run the baseline. And instead of getting, this kind of result here, I get it's negative for December and about flat for here. I have the spreadsheets elsewhere, but I was really surprised actually. There's an object lesson there in assuming that any change you make is going to be positive. So we're still. I've given that model to Davey. I'm curious to see if he uses it on specifically on his strategy, if he sees better results than without it. But the initial view here is, to me, it's surprising that it's not better. And I did two things. I did in the tests. I did just a normal baseline test with this new model. And then I did the same test simultaneously, but I would only take trades in the direction of the cross. So like here, the 13 is above the 34, so I would only take longs. Now I would think that that's going to do better. It doesn't. It does worse actually. So it's just really interesting how that how that happens. I'm still the results are still kind of percolating, and maybe I'll put them together and present them next week. I'm also curious if it would, just thinking about it, if that would work better if I change the codes that we are willing to enter on. So remove, like, I would expect all the turn codes to just be completely skipped, right? Because if you're getting a short up here, this is a clear turn area. If you're getting a short up here, that's going to get skipped, right? Because you're saying you're only going to go long here. You're not going to go short until that happens. So that kind of suggests to me that you're never going to get a turn code that's worth it. So you just take them out and see what happens. So I'm just thinking about that. Maybe I'll run another test and see if that's the case. In which case you're basically using the machine learning system more for just like pullbacks or trend following. It's interesting. And then I was also thinking about, okay, did I present the data to the machine in the wrong way? The number you're seeing on here is the delta between the 13 and the 34. So a positive number means that the 13 is above the 34, and the bigger the number, the further above it is. So, all right. And then what was the last one? So V-bar 2. All right, so the verification bar 2 spreadsheet here that we talked about, I'll upload as part of this week's package. So you can choose that and start using it if you like. I'll just upload one of them. Instead of saying NQ, it'll say like XX. So there's no difference in any of them. It's just that we have them separate because the different charts may be using different noise filters. So look for that. The difference is here in the buy entry and sell entry fields, where it's quite a bit more complex. Okay, and so this is implementing that logic that says if the bar is closing in the direction of the signal, place the order. If it's not, then wait 1 bar, wait 2 bars. Okay, and that's what that logic's doing right there. Now let's look. Do I have it up? Shoot. I don't want to change that because I'm in the middle of a replay there. Oh, I can probably do it here. Let me see. I want to look at Friday here, or maybe it was Thursday. Okay, so it happened in here somewhere, though I don't understand why the codes aren't listed there. where I got into the market and I got stopped out right there to the tick. All right. And so one of the things we've been talking about is we want to get to a point where, if I got in down here, I want to be adding here and here, right? And I want to be trailing to the zigzag instead of a hard 20 tick trail. And it's easy to do in custom programming, but I really want to avoid that. And so we're trying to figure out, well, how can I do that using native functionality in Sierra Chart? Okay. So what I want is, so the first, step one is, can I trail to the zigzag? And then step two would be, all right, trail to the zigzag and add on either the next signal, and then whatever the logic happens to be. If it's another signal long, then okay, just add to the position. We might have custom logic we want to implement where just any pullback has an add for based on whatever some conditions, and then continue to just trail to the zigzag. Okay, I'm close to having a trail to the zigzag. It's not really a trail. It's more, it was actually inspired by something Russ was talking about, which was rather than try to trail the stop, just keep track of where this level is, this level, this level, this level, and if you breach that level, flatten. Okay, so I'm close. I think I might be able to get that working next week, so we'll see. That's kind of my focus next week, is to see if I can get that working. This was super painful because there's a beautiful entry here. I end up making like 6 points instead of 20. So really, just it kind of brings home, gosh, I'd really like to do that, and then be able to test it to see does it perform better or not. All right, because this is the big problem, is that I'll notice this because it's really painful, but overall, is it better? I don't know. We'll have to see. Certainly what I can tell you is that when the market does what you see here, if you're getting in and then adding and then adding, probably not there, adding, the market just, when it's like this, you end up, ultimately what you want is you want to end up just getting out up here with a lot of contracts. It's a lot. It turns into a lot of money. And so that's kind of the motivation to get there. All right, so we'll start with, step one is, all right, can I actually trail or exit to the zigzag or not? Yes or no? And then if I can get that, okay, well then, how do I want to manage the add? All right, and it's the same thing. We'll implement the zigzag trail and then run our baseline tests. All right, then we'll implement the adding and run our baseline tests. And then I think that this adding might take a variety of forms. It might be as simple as, if I get another machine learning signal that says that is in the direction of the trade that I'm in, go ahead and take it. It might be something different. We'll be able to test them. Any pullback would be one choice. So we'll see if I can get that to work or not. The key there, for those of you that are inclined in this area, is, where is it? This cell right here. You can stick a formula in this cell that will flatten and cancel everything. This is what we want. All right, so the formula then needs to reference something that's tracking the zigzag, which I think I have now. All right, so we'll see. I'll keep you updated, but my focus this week will be on that as opposed to other modeling stuff. I'd like to get that implemented. I'm getting more and more confident that the revision of the model that we're using is sound. So between the work we did a couple weeks ago, taking the different pieces out and seeing the impact, and then like the other work this week with adding a piece of information that I was certain would help, then it doesn't, makes me think that I'm in a good spot in terms of where the model is, at least at this point. And now let's focus a bit more on trade management. So there's really two things, right? One is trade management. The other is doing a better job in the chop. Those are the two things I'm thinking about. All right, now let's see. So trail methods we talked about. V-bar 2 we talked. Okay, so this week's models. We need to look at the daily chart now. So here's where we stand. And what I've seen the last few days in particular is what looks like quite a bit more normal behavior. The overnight ranges are still high, but they're coming down. The last 2 days it was sub 40 point. Kind of the rule we have is that the average needs to be below this red line to go back to making models that use 30 tick targets instead of 45. So again, we're trying to calibrate the model to the amount of noise in the market. And when there's more noise, we want the system detecting patterns that look for bigger moves, because it helps us separate the signal from the noise better. But if we do that, if we use a 45 tick model in sort of normal times, what we find is that we don't get anywhere nearly as many trades, and we end up missing a lot of opportunities. So those baseline tests were done quite a while ago. They showed in normal times you want the 30 tick model, and in volatile times you want the 45 one. 30 ticks it's not arbitrary. Just FYI, it's 3 times the bar height. And it works out to 50% of the time the market goes sideways, and then the other 50% it either goes up 30 ticks or goes down 30 ticks. Those numbers change when you go to like a 45 tick model. More often the market is going sideways under that definition. So when I look at this here, we're kind of right at the edge. And so it's not a slam dunk, it's not like we're clearly below that level. And so I think that the conservative thing to do is stay with the 45 tick model and see if next week we continue to, if the volatility continues to settle down. And then if it does, then the following week we'd go back to normal 30 tick models. I'm a little suspicious because of this. This is a nice climb on declining volume, which suggests to me that it's not real, and we might get some nasty volatility as the market falls apart here. That's what I'm worried about. This is the signature of the funds liquidating positions, and the market's climbing on low volume. Dave is asking, what are the zigzag settings? It's different for each market. Here it's this red line, right? And it's in the predict study, Dave, and it's that number 20. So 20 ticks. It's actually 19 ticks. It's one less than that. And so the market has to move that much in order to for that wave to complete. It's a very important setting, actually, because the wave volume is part of the model. This is NQ. The name of the 30 tick model it doesn't have a separate name, Michael. It's just the model I build normally. It's actually an interesting point, because I don't change the name in any way to help you understand if it's a model that's built using what is the target. that the model was built on. And that seems like I should do that. So let me think about how to integrate that into my into the process flow. That's not a slant. It's not something that you just do easily. There's like 12 programs involved that run in series that are looking for intermediate files that have certain names. So let me think about how to do that. Okay, I actually think that's a smart thing to do. Like the reversal amount on the ES is 6, but I actually think that when you're using the ES with a tick chart, I'm sorry, the reversal amount for the ES is 8 ticks. It's basically double the bar height of the range bar. But I noticed on the ES when I was using like the 500 and the 233 tick chart that 8 seemed like too much to me. So I might change that. We'll see. I've been experimenting with building models using tick charts, and thus far, I haven't really had enough time to follow through on those experiments. So that's unfortunate. The oil model I'm going to put out this week is going to be based on a tick chart. All right. So just FYI, if you're trading oil, you need to be aware of that. It seems to me that there are some markets that are quiet enough that the range bar chart doesn't work as well. I'm not sure yet, but I haven't found. Basically in oil, I haven't found something I like yet using the range bar model. So I'm going to put out a tick chart model, and then you guys can start playing with it using your own user-defined strategies, and then based upon feedback I get, we'll make adjustments or not. Just like I did with Davey. So I built a custom model for Davey to see how does that work? Let's see. And so that ran. It was like Thursday night or something. So he's playing with that now. Philip, I was running a test using the tick chart using the range bar model on the tick chart as you logged in today for today's webinar, but I'd actually made a mistake in the chart, so I have to redo it. It's what I was doing right here. So the test on the right was, let's use every code we have in the book with VBAR2, and on the left was, let's just do the normal codes with a range bar model and the tick chart and see how that works. I screwed it up. I have to redo it. I'm pretty curious about that. It's a function. It's going to need some work maybe. But I want to get a baseline result to understand it. It's a function of how the market turns at the wave. All right, that looks different. And so the question is, how different does it look, and what is the impact of that? So Russ is pointing out that on the tick chart you need a percentage, and you're absolutely right. So if you look at the order flow study, Russ, in the settings, there's a levels mode that you can set to percentage, and then you just use this value. Percent height is now active, and I've been using 0.3, 33%. Okay. So this was part of the change to release this to user-defined strategies, because you had to be able to deal with non-range bar types. So the order flow study had to change. The price action study, the extended move reversal study had to change to deal with things like this. The fact that there's a variable height in the bars, and the fact that not every bar closes at its high or low. And those are the two assumptions that had to be dealt with. Oh, I'm sorry, Russ. So you're saying on a tick chart you need to use a percentage on the zigzag. Oh, I'm sorry. You said zigzag, Russ. I misread that as the order flow. You need to use a percentage on the zigzag. So you're talking about this value here. What governs that wave completes is a percentage of the previous wave. So it's a different calculation mode. It's mode 1, and then you put a % here. Oh, I see. I've never used that. I've always used mode 2 with a specific amount. Oh, that's interesting. What reversal percentage do you think? Huh. That's something worth investigating. You just guess. Okay. Okay. Yeah, I'm gonna need something better than guess. All right. All right. So let's see. Let me recap here. So for this week's models, I'm going to build the 45 tick models. Okay, because we're not below here yet, and we're kind of right on the edge. And then if it turns out that next week we also continue to settle down, then I'll go back to 30 tick models. Okay. So that's for the NASDAQ. For oil, I'm going to build and release a tick chart model. Okay. And then for ES, the ES is just the same as it's been. I haven't been altering the ES. Unfortunately, I've done a lot of work with the ES, so I'm not entirely sure what's best yet. I'm not sure what the baseline is for ES yet. All right, so now any last questions here before we wrap it up? Yeah, we'll talk about the results of the test here probably on Monday in the room. But so I'm very curious to see what the result is using aggressive codes plus VBAR2. Okay, so if this continues to look good, then I'll do a test. Trade activity. I'll do a test. That's where we stand right now. I'll do a test on the in a March 9th forward test using on the M contract with the volatile market model, and see what that looks like. Okay, and then we'll have those are the two baselines we have now, and then separately I'll get the tick chart test going. It uses this is a 233 tick chart on the NASDAQ, just using the rational trader behaviors, not a custom, not a user-defined strategy. And I'll see what those results are. The test I ran was invalid. I had the chart was wrong. So models will come out. It'll be late afternoon tomorrow, because I'll start running them in the next couple hours. They take a full day to run. Any last questions? That's an interesting idea, Russ, on this. Zigzag percentage. All right, gang. I will see you on Monday. Take care. Look for a message tomorrow when the model's release.